Good afternoon. My name's Brendon Gleeson. I'm here with my colleague Peter Simpson. We're both senior advisors here at Shaw Partners, part of the GP Wealth team. And today we're having a discussion with Martin Crabb, who is the Chief Investment Officer here at Shaw Partners. Martin, how are you?
I'm very well. Thanks for having me today.
Very good. Interesting start of the year. We're halfway through the second month, but already feels like it's been an eternity since the break.
Had a couple of years already, yeah.
And a lot of different forces at play at the moment. How are you seeing markets and how are you positioning portfolios? And tell us more about that.
Yeah, good question. So the theme we have for this year, Brendon, is polarized. It feels like investors are either in one camp or another. And the market volatility, I suppose, is helped explained by those different views. So as we know, in the last couple of days, if a company's missed on its earnings result, it's been absolutely smoked. I think we saw Zip down 36% today, and Hub opened up 20. So, we got these 50% moves between stocks, which just, I suppose, shows how uncertain the market is around what's going on. If I can step back and look at the macro a little bit, it all looks pretty good. Growth is certainly improving. We had some good, labour force number today in Australia. Inflation seems to be okay. Central banks, with the exception of maybe the RBA, cutting rates. So the setup looks pretty good, but the reporting season's throwing up a whole bunch of volatility. I think what's going on in the software space is also throwing in a whole bunch of uncertainty. So as you said, we're only, 6 weeks into the year. It feels like we've had 2022 and 2019 and 2016 already, right? So it's really challenging.
Absolutely. You mentioned software, obviously a pretty big move in that space. Can you expand that a little bit more? Is it an opportunity or is it
it's probably a threat and an opportunity. I suppose if we think about what's happened in the past 6 weeks, in particular the Anthropic model Claude has come out with some pretty powerful computational abilities to be able to do applications that looks like and do pretty much what all of us do and most of our colleagues in professional services can do pretty quickly. So that's got the market thinking, who's going to get wiped out by this? I had a conversation with someone earlier today and they said, do you remember the Yellow Pages? Do you remember the Gregory Street Directory? Do you remember the Melway Street Directory? So those business models got wiped out, right? So the question is now what business model will get wiped out? And as an investor, you probably shoot first and ask questions later. So I think when we talk about software, it's that concern about what software is going to stick around. So who's a Gregory's or a Melways or a Yellow Pages, and maybe who's an REA.com or a Seek.com or a car sale. So I think that's the uncertainty. From my perspective, the safety is in the hardware. So if you're providing data centers or chips or whatever else, it's kind of hard for AI to do anything but make that better. But if you're in the application software, if you're in a seats-based business, it's kind of harder to justify that. So the market's certainly shot first and asked questions later. That creates opportunity, right? So the baby gets thrown out with the bathwater. So I think there are in the Aussie market, some really good opportunities. WiseTech looks really interesting. That's a $120 stock not that long ago. It's now 40. So unless you think that business is going to get wiped out, $40 starts to look a little bit interesting.
What about on the macro though? Because it seems like AI this time is coming for the white collar worker. Are you worried that unemployment could spike up in so much debt in the world that could create a bit of a deflationary whoosh before the inevitable money printing that always will come?
Yeah, well, that's the big concern out there. If it starts to wipe out high paid jobs, then the whole economic sort of model starts to get concerned. The issue there is that if we do get a wave of productivity, that's really good for monetary policy, right? So if you listen to Governor Bullock and what she said about the Australian economy, it can't grow more than 2% because we've got no productivity. So the flip side of this AI disruption is a massive wave of productivity like what we had in 2000, 2001 with PCs, and that's going to keep deflationary pressure in the economy. It's going to push prices down, means we can have lower interest rates and higher growth. So everyone's sort of focused on the negative, like AI is going to destroy everything. It's going to put everyone out of work. The flip side to that is that it'll actually create a lot of productivity, which will keep inflation under pressure and it'll allow interest rates to come down. That's certainly what Donald Trump and Scott Bessent and these people are betting on. So that side of the coin, if you like, hasn't really been factored into markets. That's really bullish. If you think back to 2000, 2001, yes, we got carried away with the dot-com boom, and we had a big sell-off after that. But what happened in the economy was 10 years of deflation and lower interest rates and really good performance. So I think we've probably got to see through the volatility and then get the benefit on the other side.
I think one point you made around baby with the bathwater around the software space, it does feel like some of those there's opportunities there within that. And obviously being a bit biased, being active investors ourselves, how would you say charges the active versus passive argument with regards to investing?
Yeah, I think you've got to be discerning when it comes to this. I think a lot of investors have been, I suppose, tempted into ETFs that track the index because it's been really hard for active managers to beat the index because of the concentration and the Mag 7 and that sort of stuff. And it's kind of tempting to sort of just, well, I don't know what to do here, I'll buy the index. And I think what's happening now is there's bifurcation, there's winners and losers, and there's like big winners and big losers. So I think it does make sense to be a bit more discerning and maybe not buy everything in the Mag 7, maybe only buy those businesses that are going to always be there. Like Nvidia's always going to sell chips, but maybe Meta and Microsoft aren't going to have the best software. So I think now more than maybe not ever, but now more than most times, it makes a lot of sense to be active and just have that discernment about which parts of the market you're investing, because it's not a rising tides lifting all boats. We've seen that this year already. Non-US stocks have outperformed US stocks by a lot this year. Growth stocks have underperformed value stocks in Australia by almost 40% in the past 12 months. So there is big dispersion in the market, which is a threat to your portfolio, but it's also an opportunity. So I think when you get that big dispersion like we're seeing right now, which is driven by technology, active management makes a lot of sense.
And I know one area thematic that we're big on has been commodities and gold, and have been for a while. What's the outlook on that? Everyone always keeps asking about the gold price and where to from here, etc. And we see the lines at ABC Bullion, but give us
it's interesting.
You've got a couple of stocks in the portfolio.
Yeah. So we're overweight gold. So we've got probably 10% of our large cap Aussie equity portfolio in gold. So we've got across the spectrum, we've got Northern Star, Ramelius, Evolution, Genesis, and all those stocks have been great.
And they're starting to really get the cash flow coming through.
Yeah, and look, I think Genesis guided their production today to, they're digging it out of the ground, $2,500 Aussie an ounce. And I checked the gold price, it's about $7,000 Aussie. So it's a massive, it's an ounce. You ever put an ounce of something in food? It's not a lot, right? They're making $5,000 Aussie an ounce. So they're just absolutely printing cash. So that's great. The esse is that gold's obviously got hot money in it too, as you mentioned, Simo. There's a queue of people outside ABC Bullion. I went to the through the Middle East on holidays last year. There was a big queue at the Emirates airport queuing up to buy gold. So it's not just a Sydney phenomenon; it's global. So there's clearly hot money in there. So we need to be a bit cautious. But it does seem like gold has got one buyer, which is central banks, and no sellers really. Because once the central bank buys gold, it goes into the ground. It's never coming out again, right? So there's a buyer, a patient buyer that's just there every day, and there's not a lot of supply. If we found gold tomorrow, if we went over to West Australia and found gold, 7-8 years to bring it to market. So there's a big supply lag. So I kind of like gold from that perspective. I think commodities more broadly, if we're right on global growth, so global growth seems to be upgrading, then we're going to need more commodities. If the AI thing really kicks off, there's not enough copper. There's not enough uranium to fuel the energy. There's not enough of anything really. So I think being long commodities, which we're lucky being Aussies, our market's naturally long commodities. If you're in America, miners are like 1% to 2% of the index. So I think Aussie investors are well placed to benefit from that upside.
It definitely seems that this reporting season, there's that move away to hard assets and to real physical things.
Yeah. Well, I think is if you're running a software company or a professional services company, there's massive amount of uncertainty about your future. Yeah. If you're digging copper out of the ground, there's almost no uncertainty about your future. We're going to need more copper in the future, right? So whether it's data centers or solar panels or driverless vehicles or whatever, robotics, they all need copper. It's the most conductive element, right? So you saw BHP beating their chest about their results, saying we're the biggest copper miner in the world, and we saw this 3 or 4 years ago. So they're trying to merge with, or they tried to buy Anglo Glencore's trying to get together with Rio. Everyone wants more copper. So if you don't have copper in your portfolio, make sure you've got some.
The M&A will really start, even the gold space.
Yeah.
There was takeover there.
Yeah, well, Genesis have taken out magnetic. So no, for that business, magnetics is a deposit that's quite close to them. It makes a lot of sense for them to do that. They use mostly cash for that. But what you see increasingly is that companies will use their scrip, because if their scrip or their shares are highly valued, they can use them to buy other. I think we've just seen the start of M&A in the gold space and the mining space. I think that's really going to be an area. So at Shaw & Partners, we cover a lot of the junior miners and junior explorers. I think that's a space that's definitely worth looking at for your portfolio.
Absolutely. Yeah, I saw one stat that from starting to finishing, like to getting a copper mine actually running, can take 20 years in today's environment.
Yeah,
so it's just, the supply's not going to come.
It's almost as bad as building in Sydney, isn't it?
Yeah.
Well, look, appreciate your time today, Martin. As always, been great with us and our clients helping separate the signal from the noise and some of the opportunities in the marketplace. So appreciate your time, and thanks from the GP World team here at Shaw & Partners and Martin Crabb.
Always a pleasure.
Thank you again, Martin.
At GP Wealth, our goal is clear and simple. Grow and preserve your wealth with transparency and value. If you'd like a more detailed or personalised consultation, please reach out to our team today. Thank you for watching.